Imagine a time when paper money wasn't just slips of paper but tickets to unimaginable wealth. This is the story of the Mississippi Bubble, a financial episode in the early 18th century that began with ambitious plans by Scottish economist John Law to revitalize France's economy through a system of paper currency and stock issuance. The scheme became known for its dramatic rise and fall, showcasing the risks associated with speculative bubbles. In 1716, John Law, a Scottish economist with experience as a gambler, had an innovative idea. He proposed establishing a bank that would issue paper money backed by land in the French colony of Louisiana. The concept was ambitious, to transform seemingly barren lands into economic gold mines through trade and development. Let's break this down. First, Law created the Banque Gainrail, not Banque Gainrail Privé. This wasn't just any bank. It promised to back all its notes with government debt and precious metals. It meant more money in circulation, driving up prices and economic activity. People were thrilled they could spend and borrow more freely, fueling a spending spree. But here's the kicker. Law also formed the Mississippi Company, which aimed to develop the French colony of Louisiana into an economic powerhouse. Shares of the Mississippi Company soared, leading many ordinary people to experience sudden wealth. It was akin to winning the lottery, but through investments in paper assets. So how did it work? First, the government granted Law's Mississippi Company, Compagnie d'Occident, exclusive trading rights for French colonies in North America and Asia. This meant the company had a monopoly on trade with those territories, promising substantial profits from the vast natural resources and lands. The prospect of immense wealth sent people scrambling to buy shares in the company. But the real magic happened when Law's bank issued more paper money than there were precious metals backing it. This led to an increase in available credit and liquidity, which drove up asset prices and created economic activity. People felt wealthy due to rising asset values, but this wasn't sustainable as there was little actual value supporting the inflated currency. Let's look at the numbers. In just 2 years, the value of shares in John Law's Mississippi Company skyrocketed by over 8 times their initial price. Imagine buying one share for $100 and seeing it worth $800 in less than a year. It seemed like everyone could get rich fast, but every boom has its bust. As more people rushed to buy shares, the supply of new money far outpaced the actual value of assets. The bubble began to burst when John Law could not fulfill his promises of riches and profits from Louisiana. People realized they had paid top dollar for a dream that wasn't grounded in reality. The Mississippi Bubble was akin to a massive financial pyramid scheme. Early investors profited as new participants continuously purchased shares at increasingly higher prices, enabling initial buyers to sell at a premium and realize substantial gains. However, this unsustainable model eventually collapsed when it became evident that there were no significant riches awaiting investors in Louisiana. As confidence waned, people began selling their shares in large quantities. Prices fell rapidly, reversing the earlier surge. Those who held onto their investments too long suffered significant losses. This crash shocked Europe and had lasting negative effects on financial markets and stability for years to come. Here's the critical point. John Law's experiment demonstrated how easily paper money can lose its value when backed by insufficient or non-existent real assets. When investors lose confidence in an economic system, they withdraw their investments, which can lead to a rapid and severe market collapse. So why did this happen? Partly because of human psychology. People were swept up in the excitement and optimism, seeing others profit and wanting to participate as well. The allure of quick wealth drove greed and fueled speculative behavior. But there's also the role of government intervention. Law's promises were closely tied to the French crown's urgent need for funds. The king required large sums of money, and Law provided a seemingly simple solution, printing more banknotes and issuing shares to finance various ventures. However, this approach was unsustainable in the long term. The Mississippi Bubble is a cautionary tale about the dangers of unchecked speculation and overvalued assets. It illustrates how quickly a financial system can collapse when it lacks robust economic fundamentals. In short, John Law's experiment in paper money and share trading created wealth quickly, but also led to its rapid destruction. The lesson is that the pursuit of quick riches often comes with significant risks and can end in disaster. Now let's talk about the aftermath. Following the crash, there was widespread distrust in banks and financial institutions. People feared another collapse and preferred to hold gold rather than paper currency. This period is known as the bullionist period, during which trade was hindered by a lack of credit and investment, leading to prolonged economic difficulties. However, there's a silver lining. This disaster prompted reforms that strengthened banking systems around the world. It underscored the importance of backing currency with tangible assets, imposing restrictions on speculative investments, and regulating financial markets to prevent similar crises from occurring in the future. So what can we learn today? History repeats itself, especially when it comes to financial bubbles. The dot-com bubble in the late 1990s and the housing market crash in 2008 have parallels to the Mississippi bubble, which occurred during the early 1720s. They all start with hype, easy money, and a lack of regulation. Subject: the Mississippi bubble and John Law's financial experiment. In short, the Mississippi bubble was a historical cautionary tale about the dangers of unregulated financial schemes. It demonstrated that although innovative financial ideas can potentially generate substantial wealth, they also pose considerable risks when left unchecked. The story of John Law's financial experiment is more than just history. It serves as a lesson in how human behavior and economic systems can interact. Understanding this tale helps us be better prepared for similar situations in the future. This is educational and historical, not financial advice. John Law's scheme highlighted the importance of transparency and accountability in finance. Back then, there was little to no oversight or disclosure requirements. Today, while regulations have become stricter, they're still often outpaced by new financial innovations. Remember how cryptocurrencies emerged without clear guidelines. This mirrors what happened with the Mississippi Company shares. Another key takeaway is the role of speculation versus genuine investment. Law's scheme initially attracted many investors looking for quick gains rather than long-term value. This speculative frenzy drove prices far beyond their intrinsic worth, setting the stage for a dramatic crash when reality set in. Fast forward to today, and you see similar dynamics with modern financial bubbles, such as those involving cryptocurrencies or meme stocks. The Mississippi bubble highlights the dangers of centralizing financial power. When John Law's bank was granted exclusive rights to issue currency and manage finances for France, it created an environment ripe for corruption and mismanagement. This concentration of power allowed Law to manipulate stock prices and hide losses from public scrutiny. In modern times, we see echoes of this in debates over the influence of too-big-to-fail banks and monopolistic tech companies. Moreover, the bubble revealed how financial crises can have widespread societal impacts. The collapse of Law's system led not just to economic instability, but also to social unrest. People lost their savings, businesses failed, and trust in the government plummeted. This shows that financial failures are not contained, they ripple through every aspect of society. Law's experiment also brought to light the psychological aspects driving market behavior. The allure of easy money and get-rich-quick schemes can override rational decision-making. Investors often ignored red flags and piled into speculative assets, riding a wave of optimism until it crashed. This human tendency is as prevalent today as ever, evident in phenomena like cryptocurrency manias and initial public offering (IPO) pop culture. The story also highlights the importance of diversification and risk management. Those who invested heavily in John Law's ventures were hit hardest when the Mississippi bubble burst. Diversifying investments across different asset classes can protect against such catastrophic losses. This principle remains fundamental in modern finance, whether it's through index funds or balanced portfolios designed to weather market volatility. Furthermore, the Mississippi bubble demonstrated how misinformation and propaganda can fuel financial bubbles. Propaganda campaigns by John Law's supporters spread unrealistic promises about future profits from trade in the French colonies, encouraging mass speculation. Today, social media platforms enable similar phenomena where false narratives can go viral, driving asset prices far beyond their true value before collapsing. Subject: the Mississippi bubble and John Law's financial experiment. Passage to fact check. Lastly, John Law's experiment underscores the critical role of independent oversight and whistleblower protections. Without these safeguards, abuses can flourish unchecked, leading to systemic risks. Modern finance has made strides in this area, but there's always more work to be done to prevent future financial crises from forming. In conclusion, while the Mississippi bubble occurred centuries ago, its lessons are timeless. It's a stark reminder of why financial regulation and ethical business practices matter. By studying history, we can better understand the dynamics that lead to financial crises and take steps to mitigate them in the present day. This is educational and historical, not financial advice. The Mississippi bubble also highlights the dangerous allure of quick riches and how easily people can be swept up in speculative fervor. Law's scheme promised unprecedented wealth and stability, drawing in investors from across Europe. However, many ordinary citizens were lured by promises that sounded too good to be true, often investing their life savings based on nothing more than hype. One striking example was the frenzy around Mississippi Company shares. Initially priced at 500 livres, they soared to over 10,000 livres within months, fueling speculation and investment despite the risks. People sold land and possessions, even mortgaged future earnings, all in pursuit of this get-rich-quick dream. Many ended up destitute when the bubble burst, highlighting the dangers of speculative investing. Moreover, Law's experiment demonstrated how financial innovations can be exploited for personal gain at the expense of public trust. The creation of banknotes and credit without adequate backing led to rampant inflation and a significant devaluation of currency. In essence, people found their money losing value faster than they could spend it, eroding purchasing power and economic stability. Another critical lesson is the importance of transparency and accountability in financial systems. John Law's manipulation of stock prices and market information demonstrated how a lack of oversight can enable fraudulent activities. This underscored the need for robust regulatory frameworks to protect investors from similar deceptive practices. In modern times, we see echoes of the Mississippi bubble in various speculative episodes like the dot-com bubble or recent cryptocurrency manias. Each time, history repeats itself as new technologies and financial instruments offer fresh opportunities for speculation and risk-taking. Just like John Law's scheme, these often end with widespread disappointment and economic hardship for those caught unawares. Ultimately, the legacy of John Law's experiment serves as a cautionary tale about unchecked ambition and the dangers of ignoring fundamental principles of sound finance. By understanding these past mistakes, we can work towards building more resilient financial systems that prioritize integrity, stability, and protection for all investors. This is educational and historical, not financial advice.